Walk into Liam's house and you immediately feel something. It's not big. 4-bedroom, colonial, decent neighborhood, nothing that makes your jaw drop. The kitchen has the same countertops it had in 2019. His car is a 4-year-old Camry he paid $31,000 cash for and plans to drive until something important falls off. He works maybe 44 hours a week, takes 3 real vacations a year, and when the market dropped 28% in 2022, he went for a run, came home, and didn't check his account for 2 weeks. Liam is 46. His net worth is $1.84 million. Now, walk into Harry's house. Harry lives 3 miles away. He leases a $72,000 BMW, renegotiated last year into something more practical. His kitchen was renovated in 2021 for $47,000. He has a brokerage account with 6 stocks he genuinely believes in. A home worth $850,000 that he can't sell without torching his 3.1% mortgage, and a financial life that looks extremely successful from the outside and feels genuinely precarious from the inside. Harry checks his portfolio when markets move. He works 58 hours a week. He earns more than Liam most years. Harry is also 46. His net worth is $312,000. Same city, same starting income, same decade. One of them built wealth. One of them funded the appearance of it. This isn't a video about how to start building wealth. It's about every specific trap waiting for you once you already have some, the ones that are completely invisible when you have nothing and become brutally expensive the moment you do. My name is Nick, and I spend way too much time studying why people who should be financially free end up financially stuck. If that's something you want to avoid, make sure to subscribe because we're going through every single one. Trap 1, lifestyle creep, and why it gets worse the more you make. Let's start with the one that's already happening to you, and you probably haven't fully clocked it yet. Goldman Sachs surveyed over 5,000 Americans for their 2025 retirement report. And buried in that data is a number I keep coming back to. Among households earning between $250,000 and $500,000 per year, roughly 43% report living paycheck to paycheck. For those making over $500,000, it's still nearly 40%. Nearly half of people making $500,000 a year have almost nothing left over at the end of the month. Here's what makes this genuinely strange. It's actually worse at the top than in the middle. Households earning $200,000 to $300,000 only reported a 16% paycheck to paycheck rate. Something doesn't just grow on the way up, it accelerates. And that something is your standard of living quietly consuming every dollar of every raise before you even notice it's gone. There's something called the Diderot effect, named after a French philosopher who received a beautiful scarlet dressing gown as a gift and ended up in debt, replacing his entire room's furniture to match it. The desk looked shabby next to the gown. Then the chair looked wrong next to the desk. Then the rug. Then the art. He called it the dangerous new companion. Economists call it consumption cascade. Your brain calls it, I deserve this. And it doesn't stop until the money does. You upgrade the apartment. Now the furniture looks wrong. You fix the furniture. Now the car is embarrassing. You fix the car. Now the neighborhood doesn't match. Each purchase is individually justifiable. Collectively, they consume your entire net worth growth every single year without ever feeling like overspending. The fix is uncomfortable but simple. When your income goes up, your savings rate goes up first, before the lifestyle catches any of it. If you get a $15,000 raise, $8,000 goes into investments before you feel a single dollar. That one rule applied consistently is probably worth $400,000 over a career. And if you don't apply it, Goldman Sachs' data suggests you'll find ways to spend $500,000 a year and still feel broke doing it. Trap 2. Over-concentration in a single asset. This one tends to hit people who've actually been successful, which is what makes it more dangerous, not less. And tell me if this sounds familiar. You bought something, a stock, a piece of real estate, your company's equity, and it went up significantly. You told a friend about it at some point, maybe casually, maybe less casually, and now you're in a relationship with this asset. It's part of how you think about yourself financially. Selling feels like betrayal or like admitting you don't actually believe in it. So you hold and hold, and the position keeps growing as a percentage of everything you own. You are now technically gambling. You just don't feel like you are because it's worked so far. Intel was one of the most celebrated technology companies on earth in the year 2000, not a speculative startup, a dominant, profitable business with real earnings. It peaked at around $75 a share during the dot-com boom. Within 14 days of that peak, it dropped 20%. Within 22 days, 36%. After a revenue warning that September, it fell 40% in a single trading session. By late 2002, it was sitting at $12. That's an 82% decline. And here's the part that still gets me. It still hasn't recovered to where it was in the year 2000. Someone who held only Intel at the peak didn't just underperform the market. They've been waiting 25 years to break even, but Intel isn't the cautionary tale. Intel is just the one you can show on a chart. JP Morgan analyzed every Russell 3000 stock from 1980 to 2014, roughly 13,000 companies, and found that 40% suffered a permanent decline of 70% or more from their peak. In tech specifically, nearly 2/3 experienced catastrophic loss. The index returns look good because a small handful of extreme winners compensated for everyone else. You don't get to know which bucket your stock is in before you decide how much to hold. The rule most portfolio managers agree on: no single position above 10% of your portfolio. Most say 5% is safer. The attachment is the trap, not the asset itself. Trap 3. Tax inefficiency, the slow bleed nobody notices. You had a great year. Portfolio up, sold a position that doubled, you're feeling good. Then March comes, you open TurboTax, and you're staring at a number that doesn't make sense. You made $60,000 on that trade. You owe $24,480 in taxes. Not because you did anything wrong, not because of some audit. Because you sold the position in month 11 instead of month 13, you owe nearly $10,000 in unnecessary taxes on a single $50,000 gain just because you were impatient. This is what tax inefficiency looks like, not fraud. Not complexity, just timing mistakes and placement errors nobody sat you down and explained. Morningstar found the average equity mutual fund lost 1.48% of its returns annually to taxes. Compounded over 20 years, that's roughly a 35% reduction in ending wealth. On a $500,000 portfolio, you're looking at $175,000 gone. Not too bad investments, not to a crash. To poor tax management. The most common mistakes: holding high dividend stocks and REITs in a taxable brokerage instead of an IRA. Every dividend becomes a taxable event whether you wanted to sell anything or not. Not harvesting losses. When a position is down, selling it locks in a loss you can use to offset gains elsewhere without changing your market exposure. And selling before holding a full year is short-term gains are taxed up to 43.4%. Including the net investment income tax, while long-term gains max out at 23.8%. That 19.6-point spread costs you $9,800 on a $50,000 gain because you couldn't wait 2 more months. Taxes are almost certainly your single largest annual expense, bigger than your mortgage, bigger than anything else on your statement. The wealthy don't always earn more. They just make sure the IRS takes as little of it as legally possible. Trap 4. Overconfidence after early success. Here's a trap that specifically targets smart people who have done things right, which makes it very effective. You had 2 good years, the stocks you picked went up, the real estate deal worked, the business grew faster than you modeled, and your brain very naturally files this under, "I'm good at this." Psychologists call it self-attribution bias. We credit gains to skill and losses to bad luck. It's not a personality flaw, it's how human cognition is built. But in investing, that wiring is expensive. I've watched this happen to people I know. One great year in a bull market, and they start concentrating positions, moving into options, buying on margin, going from a diversified portfolio to 5 names they believe in. The boring index fund that was quietly compounding becomes a trading account that requires daily attention. and produces monthly heartburn. And here's the thing. For a while, it keeps working because markets trend up, because a rising tide makes everyone feel like they know something. The academic data on this is blunt. The researchers at the University of São Paulo tracked nearly 20,000 people who started day trading equity futures. Among those who persisted for more than 300 days, 97% lost money. Not most of them, 97%. Only 17 individuals out of nearly 20,000 earned more than the local minimum wage through trading. The researchers found no evidence of learning. Performance actually worsened the longer people persisted. The market has a very specific sense of humor. A bull market is not feedback. When the entire market is up 25% and your portfolio is up 25%, that tells you almost nothing about your skill. The test is what happens when conditions change, and by the time conditions change, overconfidence has usually already pushed you far out on the risk curve, which is exactly when you can least afford to be there. The counterintuitive protection is boredom. The most effective strategy for most people is aggressively boring. Broad index funds, automatic contributions, minimal intervention. The moment investing starts feeling exciting, that's usually a warning signal, not an invitation. Trap 5, working too much. Nobody frames this as a financial trap. It absolutely is. There's a point in wealth accumulation where your time becomes worth significantly more than your marginal labor. And most people blow right past that moment without noticing because working hard is what got them here, and slowing down feels like losing. Run this math. $5 million invested at a conservative 5% annual return generates $250,000 a year. That's $684 a day. Weekdays, weekends, national holidays, days you're sick. At that threshold, every additional hour you work needs to justify itself against the diminishing return of more income stacked on top of $684 in passive daily income. Past a certain point, you're not working for financial gain, you're working from habit. Bronnie Ware spent 8 years as a palliative care nurse in Australia, sitting with patients in their final 12 weeks. She documented the 5 most common regrets of the dying. Number 2, expressed by virtually every male patient she cared for, was, "I wish I hadn't worked so hard." Not, "I wish I'd earned more." Not, "I wish I'd taken bigger swings." "I wish I hadn't worked so hard." The question worth sitting with is simple. What is your time actually worth now compared to when you started? Because if that number hasn't changed how you allocate your hours, you're probably leaving the most valuable thing you have on the table. Trap 6, the illiquid millionaire trap. This is a trap that's genuinely new in scale, and it's minting more victims every year. Bloomberg analyzed Federal Reserve and Census Bureau data from 2023 and found that households with net worth between $1 million and $2 million had 66% of their wealth locked in illiquid assets, primarily home equity and retirement accounts. 2/3 of what they have, they cannot access without a 6-month real estate transaction, an IRS penalty, or waiting until they're 59 and a half. The illiquid millionaire is a specific kind of uncomfortable, technically wealthy, genuinely constrained. You can't move fast on an opportunity because everything you own is either locked in a house with a rate you'd be insane to abandon. Sitting in a retirement account, you'll pay 10% to touch early or committed to a private deal with a 5-year lockup. You're rich in theory. You're illiquid in practice. The practical rule, 3 to 6 months of essential expenses in actual liquid cash, not invested, not in a CD, not almost accessible, liquid. Beyond that, watch the percentage of your total net worth you can access within 30 days without material tax consequences. If that number is below 15 to 20%, the portfolio needs a liquidity audit before it needs anything else. Being technically wealthy while practically cash constrained is not a success story. It's just a nicer looking version of the same trap. Trap 7, neglecting insurance as your assets grow. This one isn't exciting to talk about, which is exactly why it causes the damage it does. As your net worth grows, you become a more valuable target in litigation. This isn't paranoia. It's math. A 2023 ACE Private Risk Services survey found that 21% of high net worth households carry zero umbrella liability insurance. Meanwhile, 13% of personal injury awards now exceed $1 million, and large jury verdicts are becoming more common, not less. One car accident, one guest who slips at a party, one situation where you're in the wrong place with the wrong outcome, and a judgment reaches past your auto and homeowner's limits straight into your investment portfolio. An umbrella policy adds $1 million in liability coverage on top of your existing policies. The annual cost is typically $300 to $600. A $5 million in umbrella coverage might cost you $800 to $1,200 annually. Still a rounding error on a meaningful portfolio, and the policy standing between a bad day and a catastrophic one. The full checklist grows with net worth, umbrella liability, updated homeowner replacement cost, increased auto liability limits, valuable articles, riders for jewelry and art, and D&O coverage if you have a business. None of these are complicated. All of them get skipped because they're not exciting and nobody reminds you to revisit them until something goes wrong. Trap 8. Confusing owning many things with being diversified. You own 6 ETFs. 4 of them are US large cap equity funds with slightly different names and nearly identical holdings. You have a brokerage account and a 401k and a Roth IRA, all invested in variations of the same thing. You feel diversified? You are not diversified. You are concentrated with extra steps. The deeper problem is correlation. In 2008, pairwise correlations between equity asset classes spiked from roughly 40% to nearly 70%. Everything moved together when it mattered most. Owning small cap US funds alongside large cap US funds didn't help. International developed markets didn't help. Almost everything dropped simultaneously because fear doesn't care about your allocation percentages. Real diversification means assets that don't respond to the same stressors. David Swensen ran Yale's endowment for 36 years, averaged 13.7% annual returns, and grew the portfolio from $1.3 billion to $42 billion by putting 60% into genuine alternatives: private equity, real assets, venture capital. His core insight, genuine diversification across uncorrelated assets, is what actually reduces long-term risk, not the number of tickers, the correlation between them. You don't need to replicate an institutional endowment, but owning international exposure, some real assets, and thinking carefully about what actually moves independently, that's the difference between real diversification and its very convincing imitation. Trap 9. Panic selling when the numbers get enormous. Here's the trap that specifically gets worse as you get wealthier, and almost nobody talks about it that way. When your portfolio was $40,000 and it dropped 20%, you lost $8,000 on paper. That hurt. But it was abstract enough that you could breathe through it. When your portfolio is $2 million and it drops 20%, you've lost $400,000. And your brain, which evolved in environments where losing that much of anything would be genuinely fatal, has no framework for processing that number calmly. The loss aversion doesn't scale with your portfolio's ability to recover. It scales with the raw dollar number, which means the wealthier you get, the stronger the pull to do something when markets fall. Dalbar's 2025 report found that in 2024, the average equity investor earned 16.5%, while the S&P 500 returned 26.3%. Over 20 years, compounding that behavioral gap turned $100,000 in a buy and hold index into over $750,000. The average investor ended up with less than half of that, nearly $372,000 lost. Not too bad. Companies, not to crashes, not to fees, to human behavior, to buying when things felt good and selling when they didn't. During the COVID crash in March 2020, investors pulled $326 billion from funds in a single month. The market bottomed on March 23rd. It rallied 70% over the next 12 months. Every dollar that fled at the low missed the entire recovery because the dollar amounts had gotten large enough to override rational thinking entirely. The protection isn't willpower, it's structure, automating contributions so there's no decision to make during a downturn, writing your plan down before the crash so you have something to hold on to when clarity evaporates, and not checking the portfolio during volatile periods unless something in your actual life has fundamentally changed. Set the strategy before the fear arrives, because once it does, you're running ancient software in a modern financial system, and the ancient software nearly always loses. Trap 10. No estate plan. This is the trap people defer longest because thinking about it requires imagining something nobody wants to imagine, and the deferral costs a fortune. Prince died in April 2016 with an estate valued at $156 million. No will, no trust, no estate plan of any kind. What happened next? 6 years of litigation, 2,711 court filings, $45 million in legal fees, $60 million in federal estate tax, and $24 million in Minnesota state estate tax. Roughly $87 million, 56% of everything he built, consumed by a problem that a proper estate plan would have largely prevented. 2 of his 6 siblings died during the probate process. A $100,000 estate plan would have saved $87 million. That math is hard to look at. Caring.com's 2025 survey found that only 26% of Americans have a will. Even among people with meaningful assets, failure to plan is the overwhelming norm. A revocable living trust avoids probate entirely. Updated beneficiary designations on your 401k, IRA, brokerage accounts, and life insurance, each of which overrides whatever your will says, cost nothing to change. These aren't complicated moves. People just don't do them because they require sitting with an uncomfortable subject long enough to take action. The Williams Group studied 3,250 wealthy families over 20 years and found 70% lost their fortune by the second generation, 90% by the third. Cornelius Vanderbilt died in 1877 with the equivalent of $3 billion in today's money. By 1973, at a family reunion of 120 descendants, not a single one was a millionaire. Building wealth is one skill. Structuring it to survive is an entirely different one. Go back to Liam and Harry for a second. Harry isn't a cautionary tale because he failed. He didn't fail. He worked hard, earned good money, made a lot of right moves. He just didn't realize the traps changed on him somewhere around the time his net worth crossed 6 figures. The risks shifted, got more sophisticated, more expensive, and nobody told him that building wealth and protecting it are 2 completely different games with 2 different skill sets. Liam didn't get to $1.84 million because he was smarter or luckier. He got there because he understood, maybe intuitively, that the enemies of growing wealth aren't the obvious ones. Not market crashes, not job loss, not bad luck. They're slow creep, emotional decisions at big dollar amounts, inaction on the boring stuff that never feels urgent until it's catastrophic. Somewhere in this list, you recognized something. Maybe it was the lifestyle creep. Maybe it was the concentrated position you're a little too attached to. Maybe it was the will you've been meaning to update for 3 years. That recognition is worth more than everything else in this video. Go fix that one thing, just one. Don't watch another 10 videos first. Go fix it today. If this helped you see something you hadn't seen before, hit subscribe, because this is what we do here. I'll see you in the next one.